G'day folks, it's James Marlay here. I'm co-founder at Livewire Markets and welcome to our webinar, Building a Diversified Income Portfolio. This is the final piece of content that we're doing in the income series that's been running on Livewire over the past month or so. And really the reason that we've decided to run this series is because it's one of the most common problems that we hear you, the investors that are using Livewire, it's one of the most common problems that you're grappling with. So what I really want to do today is I've invited two guests, James Gerrish from Shaw & Partners and Stephen Cabot from Suisse. They have different approaches to running income portfolios and generating income. And I wanted to draw on their experience to help give you some ideas, teach you a few rules, show you how they are investing, and hopefully help you answer some of those questions that you've got in dealing with this challenge. We've got questions coming through already, and I think that's going to be a really valuable opportunity for you to ping questions at the two gentlemen we've got in the room today. So, hopefully you get lots out of it. I'm really excited that you've chosen to join us today. I'm looking forward to getting into the webinar. And I should thank you, gentlemen, for coming in as well.
Thanks, James.
Thanks, James.
First of all, I just want to put up a disclaimer. Please read the disclaimer. The gentlemen here don't know your personal situation, so you should consult a professional for that more personal advice. But notwithstanding, we do want to hopefully give you some good nuggets today. In terms of the agenda, we've got two different asset allocation overviews to present to you, and I'll get the gentlemen to talk through what they own, why they own it, the role that it plays in their portfolios. We've got some rules that they follow when they start building income-focused portfolios, and they've also called out some of the mistakes that they see getting made over and over again. So I think that's obviously a sensible thing to do, is if we can help you from tripping up on some of those common mistakes. We'll go into some current opportunities. I actually don't even know what the gentlemen have brought together, so it's going to be some new information for me too. And then we'll get into the Q&A session, which is really your opportunity to, if you've got burning questions or if the session brings up some questions for you, that's your chance to jump in. We'll try and get through as many as we can. In the event that we don't get through all the questions, on Livewire, what we'll look at doing is putting together a bit of a blog post and see if there's some common themes, and we'll put together an article and maybe work with a few of our contributors to get some answers for you. On that note, when it comes to asking a question, two ways to do it. You can leave a comment in the comments box, which is at the bottom of the article that you're on at the moment. Hit submit, and then our team will pick that up and push that through. They'll try and filter that through to me. Or alternatively, the humble email still works very well. Send an email to team@livewiremarkets.com. So without further ado, let's get into it. Let's get into the sort of the core of the issue. And James, first cab off the rank. We've got the asset mix that you put together for your income portfolios. We need you to talk through us what the different line items are and explain for those people the neutral position and the overweight, underweight that you're showing us there. But as a starting point, what is the goal from an income perspective that you're trying to achieve with this mix?
Yeah, well, it's providing stability of returns and a consistent level of income without, putting too much capital at risk. I think, we're all out there in the markets, and you've seen what happened with, the RBA cut interest rates. Again, we're at 1% RBA cash rate. It's really difficult to go out there and generate strong income from portfolios. So having a look at the asset allocation mix that we run, the neutral stances.
But in terms of the headline number yield, I think it's everyone's. Am I getting 1%, 2%?
So,
what's a realistic objective for you?
A portfolio like this is looking to be 3.5% over the cash rate.
Okay.
So right now, 4.5%.
Yep.
From an income perspective. So this has got a mix of equities in there. It's obviously got the start and neutral setting around debt, so bonds and fixed income style investments. We're a little bit different in terms of how we have exposure in the hybrid space. So hybrids, they're certainly not debt. They're a higher risk income security. They're listed on the ASX. We've got a neutral stance across our income goal-based portfolios of 25%. We're slightly overweight that at the moment, just given the relative valuation around hybrids. So hybrids are not cheap at this point in time. So going back 12 months or so, you're getting 4% over the bank bill rate. You're now getting sub 3% over the bank bill rate for a 5-year tier 1 financial hybrids. So while they're not, in absolute terms, they are they're no longer cheap where they were trading.
Rather than absolute, you're talking about a relatively more attractive
exactly
proposition.
Right. So in terms of hybrids, we're at 28% across our income models. Aussie shares, we're underweight Aussie shares at the moment, just from a relative valuation perspective. So this is more a tactical stance. So in May, overseas equities were weak in US dollar terms. Overseas equities were down about 6%. Aussie equities were strong on the back of a election victory, or surprise election victory from the coalition government. So that pushed Aussie shares higher and US shares or overseas shares lower. So from a relative standpoint, we've now got underweight Aussie shares, overweight international shares.
On that point, is the income being generated there, is it from capital appreciation and selling positions and paying that out? Or are you looking for dividend-paying international shares as well?
Yeah, well, shares are a combination of income, franking credits, and some capital growth over time. So, your international allocations, obviously, if you look at the S&P 500, its yields around 2%, whereas the Aussie market's yielding sort of low fours at the moment across the ASX 200. So, Aussie shares are better yielding investments. But from a diversification point of view, and that combination of capital growth and income, then you want a mix of both. Liquid alternatives are sort of a big area. So
it's quite opaque, isn't it? Liquid alternatives. What is this?
Well, alternatives are
kind of like a new type of beer. What's this? Liquid alternative.
It sounds pretty. It sounds quite interesting. So alternative assets are like hedge funds, commodities, sort of taking more traditional asset classes like shares and investing in them slightly different, so short selling, etc. So, and the liquid component of that is just being able to get in and out of them. Yeah, it means listed or having some sort of liquidity in them, not tying up money for extended periods of time. And then obviously cash, we're sort of a bit over weighting cash at the moment, not because cash is yielding anything spectacularly, but just because of the valuation of asset prices generally around the world. So. That sort of speaks to it. The big obvious ones to me in there are our differences in hybrids, which we've spoken to, and we can dig into that a little bit later. And also just the short-term tactical stance being underweight Aussie equities.
That's quite a big underweight, that Aussie position, and it's interesting.
Sticks out, doesn't it?
It really does. It really does. And I was looking at some Australian dividend-paying shares yesterday, and when you look at, there still are some quite attractive, albeit historical, yields on some of these stocks, but in the bigger companies, the banks are still in high single digits. Some of the major resources companies have got very high yields on them as well. So I was actually quite surprised from an income perspective to see that was such a strong underweight.
Absolutely. I mean, if you look at the ASX 200, it yields, I think, on a forward basis, 4.09%, about 75% frank. So, relative to other asset classes, it looks reasonable. You're talking about BHP, Rio, etc., yielding a lot, which is, that's probably that's obviously a function of what iron ore prices are doing. And I've always been taught, don't buy, resource stocks for yield. They are very cyclical, but there's no doubt about it. They're pushing off a huge amount of cash at the moment, and that's being, paid back in dividends. So for now, that makes sense.
Great. Alrighty. Well explained. We will dig into some of that a bit later, but Stephen?
Sure. So what we have here are three different risk profiles that focus on the more conservative end of the investment spectrum, which when we're chasing income, that's generally where people are thinking that they tend to be that more conservative. The three profiles here, probably most similar to what James has talked about, is balanced, our third profile that we have listed, where we have across each of the profiles a 5% allocation, strategic allocation to cash, and again we take the tactical weights and we're underweight cash in our portfolios at the moment, is the way we're positioned. Bonds, so bonds is where we see the big differentiation. So on the more conservative side, we have a much higher allocation to bonds, and that trends down to where we hit balanced, where we have the 35% allocation.
In the bond space, is that corporate and government? What's under that banner?
It is both corporate and government. However, how we're positioned at the moment, because we have, particularly if we focus on the balanced profile as the discussion point, because we have equity allocation there, and we split it 50-50 as a starting point between domestic and international. It's about 42.5% is our starting weight there. because we have a reasonable amount of risk there, in the bond portfolio at the moment, we actually have an overweight to government bonds, seeking that ballast to offset the risk that we have in the equity side of the portfolio. So at different stages we have more corporate credit, but given that the equity allocation and there is a bit of a link between the credit performance and the equity allocation, we've moved more government bond exposure. Now the risk there, or the dilemma there, of course, is that they yield very little, and it has been a wonderful allocation over the last a couple of years.
From a capital perspective, right?
From a capital perspective, that's right. And it's worked out very well. And in fact, some of the bond exposure that we have in some of our advisory portfolios where we work with clients has been US dollar treasuries. And that's also added and normally we don't take any currency positions in the bond exposure. Our default position is you want that to be a stable allocation. But where the Aussie dollar was and where we saw the world going, we thought it doesn't hurt to, it's a view to have some actual US dollar exposure there as well, and treasuries, and so that's worked out well. Now going forward, that becomes a dilemma again as to where do we look for yield going forward. But at the moment, we're comfortable with the ballast, the safety net that's providing, even though they're very low yield numbers. In the alternatives, we have alternatives as well. We've sort of split them out a little bit more there, the way we think about them. Hedge funds, again, similar to what James was talking about as well. So these are solutions that often invest in the fixed income or the equities or both markets. They take long and short positions. They can have less liquid terms. Some of them are, might be weekly or monthly. You can get much longer ones, but we try and generally concentrate on the liquid ones for most of our portfolios, and if clients are comfortable, we can then talk to them about alternative ideas as well, which has been something that has been interesting for some of our clients. Real estate, real estate's something that Credit Suisse globally classifies separately, but I think most Australians probably regard that as Aussie equity exposure with REITs and so on. And then commodities, we have some commodity exposure, and that includes some gold as well as the broader diversified commodities as well.
So I'm going to put a couple of questions to you, similar to what I did with James.
Sure.
If we stay focused on the balanced portfolio there, or balanced allocation, what sort of income, what sort of return are you hoping to generate?
Yeah, very similar to what James mentioned as well. So it's sort of like the CPI or cash plus 3 to 4 is where it's targeting. Over the past couple of years, it's actually done a lot better than that. We've had the tailwinds of equity markets and bonds performing at the same time, and so it has delivered better. In terms of the way that we think about it, though, it is a total return in that we're not targeting a certain income proportion and then the capital return. Mm-hmm. It is the total return that we are focused on. So that's something that we think is important to have that discussion with clients up front to make sure that if someone is genuinely trying to seek returns from income, distributions, dividends and the like for a cash flow reason, we would be encouraging them to think about accepting that you might have to sell some actual capital from time to time.
Yeah. Right. I think that's a really important point, because that regular distribution, I know that's sort of at the core of the problem that a lot of people are trying to solve. Yeah. And the numbers that we've talked about from a yield perspective, they're still quite skinny, even when you add in some of these riskier assets and that sort of stuff. So I think that talking about what is making up the distribution is some of it selling down capital as well.
If you think of a traditional balanced portfolio similar to that one, over the last 12 months, you're thinking, it's got 9-10% out of it, probably more if it's had the currency tailwind as well. So they're really good returns out of a balanced portfolio that doesn't experience the volatility that general equity portfolios do. Mm-hmm. Going forward, though, you're sitting here with that conundrum around it doesn't excite me to sit there and say we want to deliver you 1% plus 3.5% margin on top of that. There's not too many people out there excited over 4.5% return. So it comes down to sort of thinking outside the box within those areas within that asset allocation. So thinking about the equity piece and how you can add more value in terms of the equity piece. Thinking about the fixed income piece where you can actually generate a bit more value, and going up and down, like the slide that I showed before, was just around, tactically going from neutral to underweight to overweight, and that active management piece I think gets more it has more importance now when interest rates are so low.
Stephen, this is your central, your starting point. Can you give me a flavour for overweights and underweights?
Yeah, sure. So as mentioned, cash, we're underweight cash at the moment. Cash is generally not adding a huge amount to returns, and to be honest, a lot of our clients will keep a cash pool alongside the money that we're investing for them as well. So, and we encourage that as well. It makes sense to have, if you need money in the near to short term, it makes sense to have that locked in at a cash that's highly liquid and not at the mercy of the markets. Bonds, as mentioned, we're kind of about benchmark weight in bonds, but have that skew to the quality and actually longer duration. So we're using that to be comfortable then with our equity exposure. Aussie equities, we're neutral. We were a bit worried about equities, Aussie equities in particular, coming into the election, and then after the election, with the removal of the negative gearing concerns, the franking credits, and then also coinciding with the RBA talking about providing more stimulus, APRA coming out looking at the rules of serviceability of loans, like that all combined together to make the Aussie equity market look a little bit more attractive. So we were then comfortable maintaining our neutral position. Internationally, we have a preference for US equities at the moment. Europe, we're not so enamoured with. We're underweight Europe, overweight US. We were overweight emerging markets as well, but recently downgraded that, and that's around a lot of the trade concerns. We think they're the likely losers in some of this in the short term. We think that the central banks around the world, the Fed's made it obvious as well that they're willing to support the economy. So if we get that slowdown, which we seem to be getting a bit of a slowdown in the States, they're willing to step in, and that's going to provide some support there. So the US, we're overweight. And then the alternate space in general, we're neutral. So we don't have any big positions on in terms of over and underweights at the moment, but that's a fluid discussion that gets moved regularly.
Great. All right, next part of our session, we're going to go through a couple of practical steps that, and the rules that you live by when you're investing. So James, I'm actually just going to hand it over to you and just talk me through your philosophy when you come to building portfolios. And Stephen, feel free to jump in at any stage as well.
Sure, there's probably a bit of overlap here.
Well, I just started with saying, expect the best but prepare for the worst, and that's what that has its basis around asset allocation, etc. So if you think about what you're trying to achieve out of a portfolio, asset allocate to meet those objectives, you're preparing essentially for the worst. So Stephen made mention of having a government bonds, a large proportion of government bonds, because they've got a neutral stance on equities. So that is about, if there's volatility in the equity market, and then you're also, you've got a big allocation to corporate debt, then you're going to have more of a volatile portfolio, which some people are absolutely comfortable with that. But it comes down to, looking at the markets with rose-coloured glasses and hoping that happens, but also preparing for things that often come from left field. We don't see on both sides of the ledger. I don't think, from the market's reaction around the coalition victory in the election, that's a positive surprise for the market. No one expected, Westpac shares to rally 9% on the Monday, following an election, etc. So both sides of the ledger, understanding underlying exposure. It never ceases to amaze me that people buy things and don't have a real understanding of what they're buying. So, the underlying exposures that they're buying, I think that's a really important one, whether it be in terms of an equity, the income stream, the earnings of a company, and how that, different changes in economic circumstances will have an impact on those earnings. So you obviously buy you buy a company and pay a price because of stability, visibility of earnings and growth in earnings. So it's having an understanding of the earnings is important, and quality versus quantum of income. So Telstra is a good example here. So Telstra had been under a lot of pressure. They were paying out the vast bulk of their earnings out in dividends. Since they cut their dividend, they took a really aggressive stance of cutting their dividend, realigning their business more sustainably. And that's, I think, they've gone from, and you've shown it on the share price, what the market pays for quality of income rather than quantum of income. We saw it with
NAB as well.
With NAB as well. There've been a strong outperformer. They've done some better things in terms of their business bank as well, but it's the miners.
The market likes the certainty, doesn't it?
Yeah, I mean the market. You go back and think of the mining companies, Rio and BHP had this stupid, progressive dividend policy that was, ridiculous. When they shied away, when they removed that, it was a real, positive for their share price, which is, rightly so. Think outside the box and don't follow the crowd is a pretty.
Can you give me an example there?
So thinking outside the box in terms of strategies, from an equity point of view, I often buy equities and write options over the top of them to generate additional return, a little bit outside of the box. This chase into, if you go back a couple of years, there was a massive chase into banks.
Yep.
So CBA got to $96, etc. Everyone loved the banks. And following the crowd wasn't, a great way to go. Telstra, a similar situation. We had our institutional charity day at Shaw about 12 months ago, and it corresponded with Telstra downgrading, cutting its dividend, and we had massive flow through the desk on Telstra.
People
on
buying
that day.
or selling.
Yeah, both, but that was the low in the stock. So that was, the 2.50 low or whatever it was in Telstra on that day. The day that they came out, they downgraded earnings, they realigned their business. That was the height of negativity. The crowd was, threw their hands up in the air and got rid of Telstra. The retail investors primarily out there, cutting dividend, the stock must be in trouble. But that was the great time to go out there and think about the sustainability of their business model going forward, and it's rallied $1 since then. And I'm a big proponent of active management, particularly in this type of environment, but always. So, I'm talking my own approach here, but active management is what I try and deliver for clients.
Very good. Stephen?
Yes, and so when we first meet a client, we spend the time trying to understand risk, and risk can mean different things to different people. So it is, delving into the discussion and understanding, what they perceive as risk. And we break risk into two components. The first being riskability. So that is how much can you afford. So, that depends on how much money you've got, how much you're earning, if any, and how much you're spending. And based on that can limit the amount of risk you can take.
Right.
The other side is risk tolerance, and that's more of a qualitative. You can't quantify that quite as easily. It's the point where you start losing sleep at night. If there's a pain point, and often it can be a dollar number, it can be a frequency of negative returns,
Percentage
a percentage fall. Exactly. They're the type of things that we like to try and talk to clients about, and different clients gravitate to different measures, different understanding of it.
And it's probably less than what they tell you at the start as well.
Absolutely. I mean, fortunately is probably not the right way of describing it, but there is a real test of what happened in the GFC to see how clients react in that period, because that's obviously a severe stress event. And if they sat into or went into that at a certain allocation and were comfortable sitting through it, then that's a great test to say, yes, that made sense. Now, as life goes on, people get older and their circumstances change. That doesn't always hold up, so people do get a little bit more conservative as they get older, so you've got to continually look at it. And the idea being that, once we get comfortable with what that risk is, then we determine, let's build a portfolio around that. Let's determine an asset allocation that makes sense to deliver on those objectives.
Just practically speaking, for people that are watching the webinar, for them are there any little tests they can do for themselves to work out, look in the mirror and show themselves a negative 15% and see how they feel about that? Like, how do you give them a sense of?
And it is very difficult, and that's why we try and set it out in different ways to understand. But a percentage is often one that some people can relate to. Another one is dollar. If they're investing $100 and you say, well, you've lost 30 and you're now at 70. How do you feel? Can you tolerate that? And actually, probably even preceding that is, do you believe equities will perform in the long run? Core of what we do is we believe that equities longer term will outperform, and there will be certainly periods of volatility. But if we can hold true and get through it, then we'll come back. But it's a volatile ride, and it's getting people comfortable with that volatility.
And it's drawing on, so asking people how they felt during previous volatile periods in terms of equity markets, etc. And the back end of last calendar year, we had a really volatile period. The market was at 54.10 on Christmas Eve. and now we're up here at testing all-time highs. So we have had a really volatile period. I think in the last this last financial year we had volatility in the ASX of about 22% of range, I should say, a range on the ASX. So that period tests people.
Yeah.
You really feel for how people take on board those periods of volatility.
Well, I think to your point, James, the example with Telstra is a prime example of how people's emotions and sort of their fortitude gets tested with those big moves and the volatility.
You're going to get stuff wrong, like, there's no doubt about that. You get stuff wrong all the time, but it's about having a sort of thinking about things, thinking through things, and not just reading something because someone says it on that it's going to the moon on Livewire or
Has anyone ever said that?
It's a great.
Only the right times.
Stephen, we've been through the asset class mix in your...
That's right. So diversification is key by asset class, by region, and by managers as well. That's something we think about. And coming back to what James says, we need some humility that we can be wrong, and often are. Like there's absolutely, unfortunately, a lot of examples of where we and anyone in the market has got it wrong. And so the thinking needs to be, well, if we're wrong on that, what else can we do to compensate for that? How else should we be thinking about managing a portfolio? The other thing, which I actually didn't write down here, but it's important, and depending on the level of sophistication that the clients have, so some people go to the trouble of writing investment policy statements, and that's setting out some ground rules about how to think about investing. And that can be really valuable. Now, not everyone actually goes to that level, but it's good to have some core rules that you're comfortable to live by, and that can be things like, I'm never going to allocate more than a dollar amount or a percentage to a single position. And that can help you then can stop you making some mistakes. If we are wrong. Diversification is a terrific strategy to help grow wealth over the long term. It doesn't guarantee to make you rich, and whereas taking a single stock position you can do extremely well out of, and that's can be an argument against diversification. But the people that do that tend to have other bets that don't work as well, and so you can negate it out.
You don't hear about those ones, though.
Yeah, they're not the ones they talk about at the barbecue. That's
Great. Listen, I'm keen to get to our Q&A session because we've got quite a few questions coming through. But before we do, a couple of mistakes. I've collapsed your ideas that you sent through into one slide, and we've probably covered off a few of these ideas you were just talking about. Diversification there. I think the second point is one that is, when I was doing research on equities with high yields at the moment, I actually looked at a actively managed equity income fund versus an ETF that was purely focused on harvesting income. And the difference in the capital stability for the actively managed versus the passive or the ETF was quite dramatic, a 30% capital depreciation in the ETF. And I asked the manager, why has that happened? And it's because the ETF retrospectively selected stocks based on their yield. And so the yield had been inflated because the stock price was falling, and the screen didn't take into consideration that there may have been something fundamentally wrong with the security or with the underlying business. And I think that's a really that's a great example of where focusing on the headline yield, and particularly the rear vision mirror, which is your next point, James, buying the past, not the future.
Yeah, that was
it's a big trap.
Yeah, absolutely. I mean, I think you've hit the nail on the head, and that the strategy behind that ETF, if I know the one you're talking about, is that it's not just simply going out there and dividend stripping and moving into the next stock that's going to pay a dividend is not a it may make sense on paper, but it certainly doesn't work in reality. So that the difference between theory and reality is a big one in the markets as well. So
I think the other thing that I'm seeing a little bit of at the moment is advertisements where the biggest thing on the advertisement is a dividend yield or an income percent, and there's still some pretty high numbers floating around on some of the advertisements that I'm seeing, and I think that chasing the next idea and tying into knowing what you're buying underneath it is actually quite an important one.
Absolutely, there's a really clear example. There's a You see the banners for IPO wealth out there in the market. You
Yeah.
know, understanding what they're actually holding, they're comparing it to a term deposit. Well, it's simply not.
Yep.
So the underlying, understanding the underlying driver of that yield or what's delivering it.
Yep.
LICs are an interesting one. You know, a lot of them are passing through more than they're earning over a particular period. So they're using capital to pay
Yep.
distributions to ensure the stability of their distributions, which people tend to like.
Yep.
But that's another one. It's not just passing through the income that LIC is generating or the capital growth over a period that LIC is generating.
Yep.
It can often be dipping into cash to do that.
Yeah. Believing, spin, or tips from friends and experts. Gosh. Who put this? I'm assuming the expert we're talking about is the Uber driver.
Well, that's the classic, talked about situation, isn't it? When you start getting tips from your Uber taxi driver or similar, that's when we're heading towards market top.
Bitcoin.
Now, Bitcoin's one of the ones, and that fits into the fear of missing out as well. I think there's been a lot of speculation. And people have made money out of that idea, but it's incredibly volatile and it's not, I don't think, very well understood yet, and I've not developed enough to be something that we consider as a stable investment at the moment.
There's a difference between actual advice and strategic advice around asset allocation and investments, etc., versus marketing spin. So you see a lot of marketing spin in terms of investment products. They're everywhere. And, you've got to be really conscious of not believing in that marketing spin, if you like.
Yeah. Alrighty. I've asked each of you to talk to some specific opportunities or some areas where you think that the people might warrant doing some additional research, or where you're finding some value. James, what have you brought along for me?
Well, I just had one quick stock idea, and it's around there's a couple of stock ideas, but it's involving a dividend, selling a call option over the top of it, and getting a good return over the next three months. So Illumina as a stock, trading at $2.40. You can buy the stock.
The historic yield on that is 18%.
It is, but again, it's not going to be that way so last year they paid dividends of 30 cents. This year they're going to pay something around the 17, 18 cents in dividends. They've got one coming up soon. So you can buy the stock, sell a call option for around 8 cents on that. You can pick up the 9 cent dividend, which is happening in the next month or so, and sit there and look at about a 12% return. Obviously, you've got the risk of the stock going down, but you have mitigated some of that by writing the call. So I think from an equity standpoint, when market valuations are high, etc., strategies like that can actually be quite useful for investors out there.
Yep.
Banks are another one. CBA has got a dividend next month, so you can write options around CBA to potentially increase the yield, but also give some buffer if CBA comes down a little bit.
Okay, great. Stephen?
Yeah, so from my side, I mean, absolutely, I understand what James is saying, and the strategy there makes perfect sense. From my side, I would encourage, and I know this probably is in a bit of contrast to the name of the discussion, but to think about the total return more. And interestingly, areas where we've seen a lot of interest from our clients has been around the non-income producing, more capital generative ideas. So areas where we've seen interest, and that is they've got exposure to their traditional asset classes. They're looking at private equity as something. Now that is something that definitely you need to get comfortable with as an investor around the time frame. It's highly illiquid, so that can rule a lot of people out. But if you're willing to lock your money up for a period of time, you can harvest a premium for that over the longer term. So that's an area where we've seen increased activity, along with uncorrelated assets. So that's the holy grail of portfolio theory, and it's in the alternatives, the hedge funds, looking for hedge funds that can act in a different way to the equity market. So that's where we've been trying to focus a lot of effort, concentrating absolutely on quality of income, getting the equity and fixed income calls right as best we can, but looking for that other areas to add.
Great.
It forces you to do different things in this sort of market, I think.
Yeah.
But within that, within an asset allocation framework.
Okay, great. We're up to the Q&A session. So hopefully for all the listeners that have been tuning in, you got some good insights out of that discussion that we've just had now. I think it's some really sensible ideas in there. So thank you very much, gentlemen. We've got some questions already. I'm going to try and get through as many as possible. So let's try and keep our answers snappy, a bit from both of you. Some of these are very income focused. Some of them are a little more markets related. I'm going to take everything, but just bear in mind this was the income session, so I'll probably cherry pick a few of those ones. But yeah, as you can see on the screen right now, if you want to ask a question, you can leave a comment in the comments box below or send through an email to team at Livewire Markets. My first question is from Gillian, and Stephen, probably one for you. Are global funds riskier in the current environment?
Global funds certainly have a different aspect about them where you've got currency to consider as well. So that's an immediate consideration that people need to take into account. In terms of are they riskier, within a portfolio concept where you've got some Aussie equities, you complement that with some global equities, it can be a diversifier of risk. That's the way that we think about it and try and structure it. And part of it is you're getting exposure to different countries at different stages of the economic cycle. Also, you're getting exposure to potentially areas you can't get exposure to or not great amounts of exposure to here locally. So, tech and healthcare are two examples that, offshore there's some a much wider opportunity set to look at. So,
what are some of the rules of thumb that you follow when you choose a fund manager? Because I think an Australian fund can be risky if it's not well run or not well managed.
Yeah,
what are a couple of rules for choosing a fund manager?
We spend a lot of time as a business doing analysis on fund managers to understand who are the key decision makers, what's the operational setup, can we get comfortable with all the procedures that are in place, understand the philosophy of the manager. There's different managers that have different styles. It's making sure we're aware of that, and there can be times when those styles are out of favour, so they can be underperforming the market, and if you know what they're doing and you're comfortable with the style that you've selected, you get comfortable with them underperforming in certain stages of the market as well. So it's making sure you know the manager, what they're doing, and you're comfortable with it. Now, you've got to keep on top of it as well, because a lot of these managers are very reliant on a couple of key individuals. Yep. And should they go, you want to make sure that you're aware, and then you can reassess to decide if you want to stay in with them or not.
Great. Quick question, I kind of feel like we covered this, but I'm going to put it out there. What's a reasonable return expectation for an income-based portfolio for a self-funded retiree?
We're right now about 4.5%. It depends how high in the risk spectrum you want to go to. So the equity market's yielding in the 4s. Hybrids now, across the universe of hybrids, I think they're about 4.5% gross for franking for a tier 1 with 5 years to run. Government bonds, a 1.5 with a 6-year 6-year duration. Corporate bonds, so there's a couple of listed investment trusts on the ASX that invest in corporate bonds. NBI is.
I might come into those credit products in a minute. We'll have a bit of a deep dive into those.
Just back onto just around risk around international equities. One point I would make is just around where those international equities are domiciled. So I don't think there's more risk in US equities. I think there's probably more risk in European equities at the moment. And I think there's a risk of those businesses domiciled in Asia. I think that's it's proven Asian domiciled equities are a lot more volatile than US domiciled equities, irrespective of where they're actually getting their earnings from.
Yeah. Okay. I think this is a topical one on hybrids. What have been the effects of the reducing the bank bill swap rate or interest rates on these retail access products like hybrids? What's the impact? What do investors need to know about the impact of these falling rates?
Yeah, they're floating, so you're getting a lower return. So 90-day bank bills at 1.17%. You put your margin on top of 3% if you can get it now. Yeah. And that's your return. So as interest rates fall, then your return falls. So I don't think, but they're still paying a bigger margin over a bank bill rate than a lot of other assets out there. So that margin's still important. So
yeah, I think there's a bit of an anchoring effect that affects us all, I believe, which is, we're used to higher rates, higher numbers, higher returns, and that's based on history. What we've seen is the cash rate has come down enormously. So the risk-free rate, which basically most of the the items we're talking about are based on in terms of their pricing. As that's come down, we've got to accept lower returns. Now the spreads, as long as the spreads are there, we're still earning the same premium.
Yeah.
It's just that its
The
headline
absolute
number is smaller.
And that's why equity prices are up. That's why bond prices are up, hybrid prices are up.
Yeah.
Yeah.
Great. Thanks, John, for that question. Graham has said he's got two questions. I think they're both interesting. The first one we've sort of touched on. He's interested in the role of Australian resources stocks in an income portfolio. And we touched on that earlier. I had a discussion, as I said, with an income-focused equity manager yesterday. His view was that over the medium term, and he agreed about the cyclicality of earnings that you spoke to, James, he still felt that resources stocks presented a good short to medium term opportunity. I'm quoting his view there. Gentlemen, role of resources stocks.
Look, I'd say, if you haven't had resources in your portfolio for the last 6 months, 12 months, they've been some of the star performers. So in total return of the market and the portfolio, you'd be lagging. Now, that may not be relevant if you are totally focused on income.
Yep.
And if you are, you will build a different portfolio, but you need to be comfortable with that divergence in performance, which is working against you now. There'll be a time it'll work for you. But in terms of a broad portfolio, it's hard to have an Aussie equity portfolio without some of that material exposure there somewhere.
Yeah, going forward, you've just got to have the commodity price tailwind. So, iron ore producers have got that. I think iron ore will stay higher for longer. I think there's a lot of evidence to say that Marlay and other mines won't come back on stream as quick as perhaps was expected after the disaster. If I look at Chinese stockpiles, etc., of iron ore, they're incredibly low. I think the Chinese have underestimated the extent and how long Marlay's production to be off stream. So, but they're not all like that. So that's the iron ore name. So I think they'll stay stronger for longer.
Yep.
And there'll be some really good dividends to be accrued over the next 12 to 18 months in those names. You think about, I made mention of alumina. So, that one's the commodity. It doesn't have a commodity price tailwind at the moment. Coal. Coal prices are down 30% from their highs, so there's no commodity price tailwind there. Copper's been pretty muted. If we're going into a global economic slowdown, that's why rates are being cut.
Yep.
Then copper probably doesn't have a commodity price tailwind. So it's again, you've got to be active management and focus on the ones that have got that commodity price tailwind, because equities follow the commodity at the end of the day.
Yeah. Great. Next question, I think is really topical, and over the past 12 to 18 months, we've seen a lot of LICs and LITs in the credit space. We've had residential mortgage-backed security products come to market. We've had high yield global. We've had high yield local. Is it a bad time to have exposure to high yield bonds right now? And I think that question sort of relates to where we are in the business cycle. I guess a question around some of these new issues that are coming to market.
Yeah, I guess there's a question in there, or a presumption maybe. Like high yield is an asset class you can't say I don't think is bad. You can go favourable or unfavourable in the current environment. If you've got a lot of equity exposure and you're at high yield, there is a lot of correlation there. So you will, if there is a downturn in the market, both are likely to fall. That's right. So, but if you were talking about maybe lightening some of your equity exposure to take some high yield exposure, there's an argument there for doing some of that. There is an opportunity in the Australian market at the moment as the banks are stepping back from some of this lending and other groups are coming in. So that is a real opportunity that some of these groups are trying to take advantage of, and does give exposure to different areas of the market, which can be interesting. So there is a place for them. And
early days tends to be when the opportunity is not that well understood. That can be when the better returns are available, because it's new and people are not. As people become more comfortable, they and the competition comes through. Yeah,
that's absolutely right. I guess also implicit in it is a view on the Aussie cycle. Yep. Is where are we at, and if we were to get a rollover in unemployment and then we got more defaults, that can roll onto the Australian economy pretty quickly, and they're all likely to be well, not all, but there's going to be a fair bit of association there that's going to hit them all. Yeah,
James, you look at the listed space quite closely. What's your view on some of these listed credit and higher income products that have come to market.
Yeah, in our portfolios we've got NBI, which is a international bond fund
The
manager.
Neuberger Berman.
Yeah, exactly right. That's done pretty well. And you look at, if you want to think about the volatility in that, it did have a period of volatility in that December quarter.
Yep.
And that you can see the volatility in the underlying fund during that period. MXT has, for metrics, they have corporate loans.
Yep.
If you think about corporate loans, they're not priced as regularly as a NBI, etc. So it shows that it has low volatility, but there's probably more volatility underlying it than you think. And Griffin is doing an issue at the moment, and they're raising additional money. So the demand is high.
Which is residential mortgage-backed securities.
Exactly right, other asset-backed securities. So and they've done pretty well. They're raising at NTA $2, but MBI has probably done the best in terms of total return there. And all of them are targeting around that high 4s, early 5s.
Yep.
Metrics have another one, the MOT, which is higher risk. So they're targeting a lot higher returns. I didn't go into that one because of it was sort of combining equity and debt to get a higher return. So, yep.
Great. A quick one. Is it riskier to be invested in bond funds as opposed to individual direct bonds?
Generally, the answer to that's probably no. The dilemma with bonds is that a good result is you get your coupon along the way and you get your $100 back at the end. A bad result is the company defaults and goes broke and you get nothing. Now, whereas with an equity, you have unlimited upside. So you can generate very strong performance from the fact that equities can rise 3, 4, 5, 10-fold. So that there's a much higher upside opportunity. They can go to zero as well. But if a bond goes to zero, it takes you a heck of a long time to earn back that money. Now, the advantage of a bond fund can be the diversification in the LICs we were just talking about. They've got a broad underlying number of loans that underpin these products. And so, should one of them go bad, there's enough there to diversify it away. That's exactly right.
Well, I like going direct in the first instance, but if you can't achieve what you're wanting to do direct, so in terms of diversification or the assets they're holding, like the RMBS market, corporate loans, NBI has a couple of hundred overseas bonds. I can't replicate that directly, so it's got to serve a purpose. It's like a fund manager, an equities fund manager. I'm investing in them if they're doing something that's not in my skill set. So, getting exposure through funds delivers something that you can't achieve yourself.
Great. I'm going to put this slide up and introduce a question from Marvin, who's my good mate from up in Queensland. Marvin, thanks for tuning in. I've got your questions. His question is, we were all worried about what was going to happen in markets and potentially impending crash, and now rates are heading lower again. Does this mean that the crash is no longer on the table for us? And I think he's after a bit of a view. Stephen, you've asked us to put this chart through because it sets the picture, doesn't it?
It does. I mean, this shows the dilemma that we're faced in people who are chasing income. If you look, this goes back to the late 80s, and you can see that the blue line there reflects the RBA cash rate, and it was 18% back then, which is astronomical. It's trended down. It's fluctuated up and down along the various periods, but here we sit today at 1%. The gold line there is the 10-year bond rate for the Aussie government. Arguably the risk-free rate for the 10 years there, and then the red's the inflation line. If you go back even to 2000, at that stage, the cash rate or the 10-year bond was 7%, cash rates were 5%, inflation was 3%. We're now in a situation where they're all, anchored around 1%.
Yeah.
So that's that whole, premium is just evaporated. The central banks, certainly here in Australia, in the US, around the world, are still talking a very stimulatory, dovish bias, and so they're looking at the economy and want to provide support, want to generate activity, and that does certainly aid the markets. There's a question, where does this end? And I don't think anyone has a true grasp on where that situation is. But while we are getting that support, that's where we, it can be uncomfortable to be investing, but it's hard not to be as well, particularly with cash rates at 1%.
Yeah.
Yeah, well, it depends if you believe that the financial engineering will continue. So, you've got a Trump put, his election at the back end of 2020. If he wants a higher market, so there's the first one, the Powell put, Jerome Powell, Fed chair, rates going lower, and then the Z put. So in China, if the trade war does escalate, Chinese have got the capacity to go out there and put big stimulus into their economy. So if those three things stay, then asset prices will continue to hold up. I don't think right now we've got low interest rates. Growth is slow, but it's not that slow. We're not in recession. We're not. So it's got to things have got to deteriorate a lot more. I think for the market to have any meaningful decline from here, it'll happen eventually. That's what markets do.
Yeah.
They correct, and it will happen eventually. Don't know when it is, but right now I don't think it's on the cards in the near term.
Stephen, I think this is a good question for you, and while we've got this chart up, it makes a lot of sense. This is questions from Hen Mawson. Thank you, Hen. Are domestic and international government bonds overbought with the yields falling so much recently? Or is it still a good time to allocate funds into treasury bonds as the global economy slows?
I think this question could have been asked last year and the year before, and I think at that stage there would have been a lot of people saying absolutely.
Nice Bill Gross.
and he got caught on the wrong side. There's another saying, don't fight the Fed, and if the Fed's committed to driving the economy and doing whatever it takes to keep things going, then there is a chance bond yields can go lower. We've had numerous examples in Europe where yields are negative and have gone negative. It's hard to get your head around what that actually means and how to think about that. Rates here in Australia, I think the RBA still is talking, the potential for further cuts. So I think we should be prepared that is something can happen. I don't know if we get negative here in Australia. That may be something that does happen, but I don't think it's too late to buy the government bonds. I think the expectation of return from them needs to be managed.
Tempered, yes.
That's right, but they still offer that ballast in a portfolio.
It's like locking in low rates for extended periods of time. Like the Greek 10-year bond is yielding 2.2%. It's ludicrous. Like it's negative yields are ludicrous to me. But
I locked in a fixed rate for 3 years on my mortgage 9 months ago, thinking I was a clever clogs.
Yeah.
And then the RBA cut the.
I did the same, for some of it.
Yeah.
You're still not going to regret that move.
No. But it's just it's amazing how quickly things can change, and we saw that with the Fed. Everyone was expecting 3 hikes. Now it's cuts again.
If you look at the forecast for what interest rates were going to do, 12 months ago and where they are, there was no one forecasting where they were going to go.
Yeah.
Rates were going higher in the US. There was 3 interest rate hikes priced in the US markets, etc. And it's just been a massive about turn. And that happened in December. The equity markets fell off, and then this global, a coordinated about turn by central banks globally, the US, here.
I'd be complementing them with risk exposure though, like not owning them on their own. You get the equity, and if rates are going up, hopefully that means that markets are going well and equities are rising.
Great. We'll keep these moving because we've still got quite a few questions. I think this is a really good one. Why such a small allocation to real estate?
Yeah.
Well, real estate and what we have in those our model portfolios,
10%, was it?
5% in ours, and that's based around liquid real estate.
Yep.
Most of our clients have
REITs.
Yes, correct. That's right. And so most of our clients do have real estate exposure outside of the portfolios we manage, and then you get into the illiquids. You can get infrastructure and other private equity asset classes, which absolutely have a place. They don't sit in a traditional liquid portfolio that if people want income and want to be able to access it, it doesn't sit as well. But certainly property, if you're getting a rental yield and so on, that can be absolutely valuable.
Yeah, in those portfolios, a lot of people have a lot of real estate outside of those portfolios.
In your portfolios, in Aussie equities, is REITs part of that mix?
No, they're not. So I strip it out and have a separate property allocation there. But I try not to, if you have REITs, then they do have a lot of influence from the market. So I try and go direct in terms of property trusts that are not listed in terms of
unlisted property trusts.
Yeah, exactly right. So the property companies on the ASX, we hold property companies as well, but they are, very much exposed to what the market does.
Yeah.
More so.
Great. A quick question on accessing private equity. Now, for listeners out there, Stephen's approach, you tend to use a lot of unlisted trusts. Is that right, for investing in private equity? Is that how you access
that's
it?
right. So we utilise our global network to be able to access opportunities that are generally offshore opportunities as well. And so we create, Credit Suisse creates feeder vehicles where we allow our investors to aggregate demand to invest, because these private equity opportunities generally only deal with very large tickets, very large investment sizes, and so through aggregating it, we're able to partner with these groups and get access for our clients.
Yeah, you got to go. It comes back to going into a fund if you can't get access to it directly, and private equity fits into that bill.
James, there's one private equity fund, an LIC. Have you had a chance to have a look at it?
Yeah, I only briefly did when it was listing. It's the is it the Perpetual?
No, it's the Pengana.
Oh, Pengana. Sorry.
Pengana
Private to public.
Yep.
Yeah. So I didn't put money into it. I saw it on the market the other day. I think it's done pretty well. So I probably should have put some money into it.
Okay. All right, we've got a few more questions. We're getting sort of towards the end of our time, so I've got a few more questions to try and get through it. Here we go. Well, this one's on sentiment and price momentum. How should that influence people's decision to invest in stocks? James, probably one for you.
To me, I look at the technical side of things. I write a daily market report for Market Matters. So we're all about momentum and trying to be active around our equity allocations, etc. So I look at it all the time. I look at where money flow is happening globally, what markets have got momentum, what doesn't have momentum. I don't want to be sitting in a market that doesn't have any momentum. Like emerging markets have been an area that's I've had a lot of pain. So in our overseas allocations, we're not in emerging markets at the moment. US has had really strong momentum. Europe hasn't had great momentum. So yeah, I look at it a lot.
Yep.
In terms of stocks, in terms of markets, and in terms of how money flow works around the world.
Yeah, and even though we're more fundamental in our approach, but certainly the technicals are vital to understand and have a view on as well. It is relevant. Yeah.
A question around RMBS. That acronym means residential mortgage-backed securities. What role does that income generating asset class play for you, for the two of you? Do you access it? How big? How much do you manage that?
I'll defer to Stephen. I'm not an RMBS expert.
Yep.
Yes, we do, but we access it through funds, through the fund exposure that we have. It is quite a niche product to understand. You've got to make sure that you understand the makeup of everything that's in it and where you sit in the structure. So it absolutely does play a role. Yes.
Yeah. Was that allocation sitting in one of those 5% alternative buckets?
No, in that one it'd be part of the fixed income.
Yep.
Income bucket there.
Yeah, and Griffin's got a rights issue on at the moment,
yep,
which Shaw is acting for.
A question around, I think, liquidity. This one's from Marvin as well. In the event of a major correction, markets will move more quickly than I can be nimble. Whilst being fully invested up until the music stops, so we've sort of had this discussion around what's happening with rates. It sounds great in theory. I think investors are better off selling early, or am I wrong? And I think this is actually this is sort of a central question around asset allocation, isn't it?
Yeah, and the dilemma is trying to time the markets is something that very few people have had any real success in doing. We've had clients talking to us over the last couple of years saying, I think the market's toppy, I think the market's toppy, I think so. And that at some stage, absolutely, there'll be a correction and in all likelihood it will happen too quick and very few people will have actually acted on it. There'll be some people afterwards that say that they knew it was going to happen. That's why we spend that time around asset allocation, getting people comfortable with a downside scenario. So if we're wrong and the market does fall, can you live with this fall? Yeah. And that becomes very relevant at that stage, because the worst thing is that you start selling when the market's fallen. So we're not calling a fall at the moment. If we were, we wouldn't be selling everything. We'd be underweight, similar to what James is showing in his portfolio. Like you reduce your risk allocation, but we'd still have some on.
Yeah, I think what was telling for me is that in your asset allocation, you had 5% allocated to cash, and of that you are underweight, which is down 3. I see typical SMSF portfolios with 20% north of cash. And that's going to be a real drag on returns. And I think that that's one of the big things that shows up between these professionally allocated portfolios that we've seen today is the difference between, when 1% on cash and if it's almost zero when you factor in inflation. I think the chief investment officer at Credit Suisse said it to me the other week, we're the ABC portfolio, which is anything but cash. So if you've got 22% sitting in cash, it's giving you some optionality, but it's also going to be a big drag on your returns.
Yeah, that's right. And the optionality can be a way to sort of, justify or think about it, but it's the opportunity cost is significant.
Yeah, cash is, if you've got cash there, you've got ammunition to buy, interesting things that come along. And in terms of what, picking market tops are really hard to pick.
Yeah.
I would argue that, picking market bottoms when there's capitulation is probably easier to pick than market tops. So, but I was speaking with our chairman, new chairman of Shaw, who runs about $55 billion over in America. Looking at what they look for to see if there's stress coming through the markets, what they look for pre-GFC, what things are. So you've just got to be vigilant, and there's no stress in the bond space over there. There's no stress in the asset-backed securities market over in the US, which there's always signs that markets are, telling you something.
Yeah.
So you look at, as I said before, from the technical, the momentum side of things, I think it's important to have your finger on the pulse in that regard.
Great. Well, listen, I'm going to use that as a point to wrap up our discussion. We've gone about on time, a little bit over an hour, but I hope for all of the listeners out there that you've got some useful information out of that. We've got the ebook of the Income series, which has a dozen or so articles all about different asset classes, a lot of them that we've discussed today, and also an overview that sort of discusses the different risk and return profiles of the different asset classes. So keep an eye out for that on Livewire in the next few days. You'll be able to print it out, some good bedtime reading if you've got insomnia. Lots of fixed income in there. But it is, in all seriousness, there's plenty of really good information. So if you genuinely want to educate yourself and learn about some new asset classes, I recommend our Income series ebook. James, thank you very much for coming in today.
Thanks, James.
And Stephen, thank you.
Thank you, James.
If you'd like to follow up with questions with either of our two guests today, you'll see on the profile photo beneath the webinar, a contact button. Send me a note. Let me know who you'd like to be in contact with, and we can pass through your inquiry there. So if you've got specific needs and follow-up questions, we can direct those to the two gentlemen. Use the contact button at the bottom of the webinar page that you're looking at now. Thank you all for attending. I hope it was valuable, and we'll see you soon on Livewire.